There's more still to come. That is my belief. If you didn't know, the stock market is down big today, and I think this is just the start. I actually expect a little bit more than we saw today. I think a big part of why we're only down, 1.5% or so, we'll call it, is partially because it's only one day. We have to realize we're in a longer term investing paradigm. I understand there's been a whole lot of 0-day to expiry options, but things play out over a longer term. So 1.5%, it's a decent amount. There's also probably some short covering occurring. People were playing the event and they saw the event happen. They covered a lot of shorts. So my assumption is there's a lot of short covering today, and that added to some buying that occurred today. Not expecting a 5% down day in a single day, but this is as I said, there's more still to come. What is left to come? Well, we've got plenty of jobs data tomorrow and Friday. We've got CPI, we've got PCE down the pipeline a little bit, and then we've got FOMC. As the saying goes that we have tried to emphasize here on this channel, talk about every day pretty much. Yesterday we didn't, as we said on Twitter. It seemed a little redundant. Let's see what Powell says. Obviously would have been redundant if we just said the same thing again yesterday. Don't fight the Fed. Don't fight the Fed. There's no reason to do that. They control the money. Why are you going to fight the guys who control the money? Why are you going to think that you can outmuscle the force? That is the force. They make the rules. We play within their rules. You can pick stocks. You can outperform the market. Definitely possible. But you have to understand what's going on in the soil. When soil changes, the crops are different, even if it's the same seed. So the soil is a little different. Let's break down a little bit of what went down today. Higher rates. The Fed is committed to its 2% goal. They are not seeing very much progress on that. PCE is remaining quite strong, and they're steadfast in this. There's been all these bulls. It started with, the Fed is going to crush the economy and they're going to have to cut rates in this year. Obviously not true. Inflation has remained strong. The economy has remained resilient in some ways, and they have to raise rates more because you need inflation to get down. Powell made a very good point today that should put all the rate cuts, all the, doves to rest. And that is, he was talking about this with Elizabeth Warren. Yes, it's possible for 2 million people to lose jobs, but when tens of millions of people are experiencing negative real wage growth, for example, inflation going up a lot and wages going up, but not as high as inflation, which has been the case over the last year or so, that is not a good outcome. The doves, the Democrats, I guess, the people who want the Fed to take its foot off the brake, they say the Fed is going to crash the economy. What the Fed is going to do, and what they're saying they're trying to do, is not to slow the economy. That's not what they want. That's maybe a side thing that's going to happen. What they want to do, and I think all of us want this too, is to bring inflation down, to return to price stability. Wouldn't that be a great thing? Stable prices. Isn't that something you can and should come to expect? We don't want unstable prices. It causes a lot of problems. We've seen that. It's not fun. It's not enjoyable. Nobody likes it. It's hard for wages to keep up, and they're not. So we gotta get stable prices back. Wouldn't that be great? Stable prices. So this is just a little bit of a wake-up call for the market. We believe this. You watching this channel believe this. But maybe not. I don't know. You should probably hear sources you disagree with, and if you disagree with me, that's totally fine. I'm not right 100% of the time. I've changed my opinions throughout the last year. I have been bullish at points. Anyways, the Fed they're hiking. They're doing their job. They're getting to price stability. A lot of people thought, they were going to waver on that. They weren't going to do it as much. They're going in, and the job is not done. They've done a lot of work, but it's not having such an effect yet. And the paradigm, as we've said, has shifted. We're comparing everything to the COVID levels. As we said, and I believe our last video, that is years away. We're not going to be there for years because that was a highly unusual situation with interest rates so low and money so aggressively printed. It's going to take the Fed a long time, and they're going to do it too, to drain all that money out of the system. Not only are they increasing interest rates, but they're sucking money out of the system. Remember when it was all Powell printing? You saw the memes of him printing, crazy things going on, crypto, whatever. They're rolling it back now. They're sucking it all in with the vacuum cleaner. So that's just the way it is. That's what they're doing. You know, like I said, that's the soil. And that means with earnings declining, interest rates higher, and money supply shrinking, the idea that we're going to get back to previous prices doesn't make any sense. It just doesn't. The most important forces, earnings, money supply, and interest rates, are all going against that. And that's obviously an oversimplification. There will be stocks that do well, and we're going to talk about oil in a second. But that's the soil. That is what we're doing. You know, you got to deal with the weather when you're planting crops. That's just the nature of reality. So, like we said at the beginning, there's more still to come. Expect a little bit more of this behavior. Expect possibly new lows because we've seen how irrational the market was. Again, we bottomed on a worse than expected CPI because people said, wow, this must be max pain. This must be what max pain looks like. That momentum has been very strong. I will grant that. That is obviously true. But I think that is unjust. We've been saying for a while that, you know, things gotta return to reality a little bit. And I think today, we finally had an appropriate reaction to the Fed. You know, we saw Bostic last week propel a crazy rally. We saw the market peak after Powell. Today is finally a day where the market is beginning to act rational, and there'll be plenty of other things in the next coming weeks that force the market to act rational. So we're going to see how this plays out. We obviously have our positioning. We obviously have our opinions that we're sharing on these videos. That's enough for the Fed. I want to talk about one important thing because I've talked about it a lot on this channel, and I'm along this area. That is oil. I'm a big fan of oil. Oil price, and I'm talking about it today because it's weird today. It's weird to see this behavior, and I don't think it's going to last. Oil is down today, some 3%. Notice how the 10-year is not doing much. That, I think, will reverse, but, you know, just note that. People, and it's down for this reason, people expect there to be a recession. However, we just had very hot inflation in February. My assumption, based on data we've gotten from Germany, Switzerland, used car prices, February probably hot economy, probably hot jobs. Oil prices, the way this works is you buy a contract. Right now, people are buying the April contract. In order for oil prices to go down in April, based on this recession logic, the recession has to occur in April. I don't know a whole lot of people saying a recession is going to occur in April. It might. But one, a recession has to be great enough to cause a recession in April, or a drop in oil consumption in April. It needs to be a big deal for that to happen. So not only a recession, but also needs to be a big recession. So the Fed doesn't want a recession. That people are saying they want a recession. That is the bulls talking. That is the cope right there. Is there's going to be a hardcore recession. The Fed is spiraling us into a recession. The Fed is draining money out of the money supply. They're increasing interest rates, and earnings are declining. Okay, that's a different thing. Oil is being consumed. There's a supply deficit. Demand is growing and forecasted to grow at a higher rate than supply is this year. The fundamentals are intact. My point here is the reaction you're seeing in oil today is not fundamentals based. It is speculation. It is traders. It is not fundamentals of oil consumption and oil supply. Oil is very volatile. You have to get used to this if you're going to be dabbling in this space. You just got to get used to it because that's the way it is. It will be all over the place. If you've been on this channel long enough, you know that. You know that, especially in 2021. So stay calm. We have our fundamental views. We're sharing those on this channel. We do expect oil to go up. We expect the Fed to remain hawkish. We expect the stock market to sell off a bit, correct, get away from these crazy prices. Do you feel that you're getting a good deal in the businesses you're buying? Because I look at a lot of the stocks, mega cap tech stocks, mid cap tech stocks, and I don't think I'm getting a good deal. This is not venture capital. This is not you're overpaying because there's a possibility you're going to 10x. This is big leagues. This is you're buying the cash flow at this point. And you got to get, there's a market. It's a competitive market. And it's about rate of return. When yields go up, you just get a better rate of return. So why are you paying, 90 times earnings? It's insane. 90 times earnings. It would take like a 90-year bond at 1% to make that money. If I'm understanding that correctly. Obviously, there's variables in that. But we're going to stable prices, so it's not so much inflation. Interesting period. We will see what happens. That's today's video. And until next time, peace out.